What percentage of your portfolio should you have invested in your home country? The latest data that I could find shows that in the UK, we have on average around 26% of our portfolios invested in our home market, despite only making up around 4% of global equities. So in this video, we'll break down why this phenomenon occurs, why the UK is certainly not alone, and weigh up the pros and cons of having such a bias. First, let's be clear exactly what a home bias is. It's defined as a tendency for investors to overweight domestic equities relative to a diversified global benchmark. So going back to this chart, we can see that the United States has the highest percentage when it comes to home bias, but it also has the highest percentage when it comes to weighting in global equities, around 65%. If we compare that to countries such as Australia and Japan, who have around 2/3 of their weighting towards their home country, despite only making up 2 and 6% of the global market respectively. So it's clear that this is a global phenomenon. So let's have a look at some of the reasons why this occurs, while also exploring some of the pros of having such a bias. Familiarity bias. People trust local firms. People are going to know a lot more about domestic stocks simply from just seeing them more in the news and the media. They may even be a customer of the company. And just seeing a little bit more of how they operate, I think gives people a little bit more confidence to invest in that stock. I also think there's a sense of backing your own country as well. You want those domestic stocks to do well in a global environment. There's also time zones to consider if you don't want to invest into domestic stocks. If you want to invest into US stocks, for example, you can only invest into them when the US market is open, generally afternoon UK time. Same if you want to invest into Japanese stocks or Australian stocks. You either got to do it very early in the morning or very late at night if you're in the UK. So although that shouldn't have a bearing on which particular stock that you invest into, having a stock that's in the same time zone as you just makes it so much easier. Then you've got currency alignment. And if you want to invest into a foreign stock, your local currency gets converted into the country that you want to invest into. And we've seen a massive example of this in the US market this year, where we've seen the S&P 500 continuing to hit all-time highs. And UK investors who have invested into the S&P 500 are looking at their portfolios and wondering why it's not up the same percentages that they're seeing in the news. And that's because they're looking at it from a GBP perspective. And over the course of this year, the S&P 500 has gone up in value, but the dollar has also depreciated against the pound. So you have that FX risk and the offset of currency to deal with. And although, of course, that can work in both ways, I think people just like the simplicity of the currency that they earn their salary in, they pay taxes in and they spend is the same currency that they have their investments in. You've also got a local inflation hedge. So if you're seeing high inflation in your country and the prices are going up and you're seeing that when you're spending, if you've got investments in those same companies, then at least you're weighted towards that performance. If that company is making more money, they're putting their prices up, then at least you've got some exposure to that company, hopefully increasing their revenues and therefore hopefully increasing their share price. Then you've got marketing and psychology. And providers in the UK know about this home bias. So it makes sense that if they wanted to produce a global equity portfolio, if they weight it more towards the UK, it's going to align more with what the data shows. And you can see that in Vanguard's life strategy funds. Vanguard has a number of different life strategy funds based on the ratio between bonds and stocks, depending on risk tolerance. They have a life strategy 100, which is 100% invested into global equities. And despite the UK market making up just over 3% of the global market, it has a 24% weight towards UK equities. I don't believe that they're taking such an active view that the UK is going to outperform the rest of the world by such a percentage. I think it's simply down to it's easier to market. Now let's explore why it might be bad to have such a home bias. The first is sector concentration. And every country is going to have a particular sector that it's more weighted towards. For example, in the US market, it's going to be the technology stocks. In the Australian market, it's going to be financial stocks. In the UK, it's weighted towards financials to a slightly lesser extent. You've got some energy and consumer staples in there as well. So it will depend on the country that you have a home bias towards. But by betting on just one country, you are always going to be reducing your diversification. You've also got a recent historical underperformance, especially when you compare UK equities to US equities. If we compare the performance over the last 15 years, if you invested into a FTSE 100 ETF, your portfolio would be up around 216%. Compare that to an S&P 500 ETF, you'd be up over 700%. Some of that difference will be down to currency fluctuations. FX risk can work both ways. So if we look at an S&P 500 that is GBP hedged, you're still up over 500%. Of course, comparing country to country in this way, you can only see which one outperforms in hindsight. And while you may not have invested 100% towards US equities, by having a globally diversified approach, you would have around 63% of your portfolio weighted towards the US market, which means you would have captured a large portion of this outperformance over the last 15 years. Clearly, it can work both ways, but by betting on a particular country or region, you're betting that that area is going to outperform the rest of the world. By going down a global equities approach, You're simply betting on the world, you're spreading your bets, and it's a little bit more of a hands-off approach. We mentioned before that many investors prefer having their earnings, their spending, their investments all in the same currency. But this is actually wrong way risk. We think about diversification and the assets we have in our lives, our job, house, currency, they're all tied to our domestic economy. So by overweighting, we're adding more exposure and reducing diversification. And then we've got global diversification reducing volatility. If you invest into the FTSE 100, that's 100 companies that you're spreading your bets with. If you invest into a global ETF, such as Vanguard's VWRP, that invests into over 3,600 companies. So if one region, one sector, one country has a really bad underperformance or a really bad disaster, that's not going to hit your portfolio as much as having all your overweight in that one country. But I don't think it's all bad for UK investors. And I think a lot of this home bias does actually come from our history. Although the UK only makes up around 3 to 4% of the global market now, around 100 years ago, it was up around 24%. And I wonder whether we just haven't adapted enough over the course of history from going from 24% down to around 3-4% today of the global economy. And I just want to pick up on that performance point as well when we compared the UK to the US, and especially when we look over the last 15 years, the US has clearly outperformed the UK. But we're starting to see that turn, especially this year. And if we look year to date, if you invested into the FTSE 100, you'd be up around 18.8%. Compare that to the S&P 500, you'd be up only around 6.8%. The pound has appreciated against the dollar this year. So if we look at the hedge version again, you'd be up 14.5%, still less than the 18.8% going down the FTSE 100 route. Even when we look over a 5-year time horizon, the performance is very close. The FTSE 100 producing 90.3%, S&P 500 up around 96%. So while I think a small domestic tilt around 10 to 30% is absolutely fine, mainly for things like currency stability and general preference, for most people, you're going to be more diversified and you have less volatility by simply going down a globally diversified portfolio and just using a global ETF. You may look at the performance the US has had and think, I don't want 63% of my portfolio invested into what could be perceived as an overvalued market. And that's fine. You can slightly alter those percentages in many different ways. But I think having the extremes such as Australia and Japan just is not worth the risk. Let me know your thoughts on home bias. Do you have that in your portfolio? Is it something you've even considered? And is it even something that you worry about? Let me know down below in the comments. I hope you found that useful. I'll catch you in the next one.